You've probably seen that you can buy a home with less than 20% down. You can even get into a home with 0, 3, 3.5% down payment, but that's not the full story. In this video, I'll break down how much you really need to buy a home, so you know exactly what to expect before you buy a home. And how I'm going to do that is I'm going to walk you through two scenarios with some estimated numbers on an FHA loan and a conventional loan. And when I walk you through those numbers, I'm going to show you the estimated total cash you'll need to buy that home. And then at the end, I have a gift for you. It's going to be a copy of the calculator that I made that will help you run those numbers for yourself. My name's Darren Tsai. I'm a licensed mortgage and real estate broker in California. And if you haven't been on my channel is dedicated to helping people just like you build wealth through real estate education. So the best way to show you the real cost of buying a home is just using numbers. And in this example, I'm going to show two scenarios. The first, a $500,000 home price using 3.5% down on an FHA loan. And this is a really common scenario in some of these California markets, the Inland Empire, the desert, some parts of the Bay Area like Sacramento or Solano County. And then I'm also going to use a different example, an $800,000 home price using 10% down on a conventional loan. This might be a little bit more common in LA, Orange County, San Diego, some parts of the Bay Area. A big reason why I made this tool was I get asked a lot, what's the max purchase price? What do my monthly payments look like? How much cash will I need? So I did my best to make something that would answer all those questions in a simple way. All right, let's dive into it. Okay, so let's dive into this spreadsheet that I made called the Purchase Price Planner. It's going to quickly help you figure out what home price fits your budget. And this way, when you start looking for homes, you're going to have full confidence. Two quick notes about this spreadsheet. Number one, you're going to see here, you only change the numbers that are in blue. So if it's a blue cell that has white text, you change it. Other than that, don't touch it. And the second thing is that this calculator will only work in Google Sheets. So if you end up wanting a free copy of this, there's going to be a link in the description below. You can make a copy, but it will only work in Google Sheets. There's also a tutorial video here that will walk you through everything, but also this video will walk you through it. So you should have a good idea of how to use it. Obviously, if you have any questions about it too, you can just email me at darren@realdarrensci.com. Okay, now let's go through the $500,000 purchase price example, 3.5% down FHA. You're going to go right here. This will take you to your numbers tab. And like I said, blue means you change it. Real quick, just some FHA loan requirements before we put it all into the spreadsheet. I'm not going to go super into detail. I'm just going to cover it really quickly. If you want to know more about FHA loans, there's a link to another video where I cover all the requirements for it. But the first thing that you need to know is that with an FHA loan, the minimum credit score for putting 3.5% down is 580. If you have below a 580 and at least a 500, you can go with 10% down. In this example, we are assuming this person has a credit score over 580 and they're going with 3.5% down for FHA. As of today, the average is probably 6.5%. You can just Google average FHA interest rate, put in whatever you find in here. This is just for estimating purposes anyways. It's not an official loan approval or anything. How long is your mortgage? Most of the time people use a 30-year fixed mortgage. Sometimes it goes down to 15. Now this one, property tax. Now this is going to change depending on where you live. In this example, we're going to say it is in the Inland Empire of Southern California. Typically the property tax is going to be about 1.1%. In the spreadsheet, 1.1% would be 110. If it was 0.8, then it would be 80. And then for insurance rate, if you don't know, you can just use this 30. That just means it's 0.3%. And then mortgage insurance. So with mortgage insurance on an FHA loan, it actually has two parts. It requires an upfront mortgage insurance premium of 1.75% of the loan balance. And then you're also going to be paying a monthly mortgage insurance premium. But the good thing is, you don't need to calculate all that stuff. The spreadsheet will do it for you. Here, you're going to pick FHA, and we're going to assume that this person is buying a single family home. So there's not going to be HOA fee. Income tax rate, you could probably just put 20% here. And this income tax rate actually is not related to qualifying for your mortgage, but I have it in this calculator to help you look at what you take home, your monthly net income. So the income tax rate actually doesn't have anything to do with mortgage qualification. I just included it in this spreadsheet so you can look at these monthly costs compared to what you actually take home. We both know that your gross income is not what you take home. So now that we've filled in this top part, the house numbers, we're going to go into income and debts. So the next pieces of information that you're going to be filling in are going to be related to your gross annual income and then your monthly debts. Let's say it's a married couple and one person makes $80,000. And when we talk about debts, we're only talking about debts that have a balance. So car loans, student loans, credit cards, personal loans, alimony, child support, if you have another property. But stuff that will not be included is your rent, groceries, utility, phone bill, insurance. Those would not count here. So let's say they have a car payment of $350, and let's say the other person here makes $50,000 a year. Their car payment is $300. They have student loans of $100 a month. And so this gives them an estimated net monthly income of $8,700 roughly. Oh, student loans, I put 1,000. I meant to be 100 a month. So now when we go into this purchase price planner, this is the suggested number. It's a comfortable zone. And the suggested is about a $400,000 purchase, which would be an all-in payment of around $3,000. Shows you a down payment of 3.5%, which is around $14K, and then estimated closing costs around $10,000. And then this portion shows you your total payment broken down by your mortgage, which would be about $2,400. Property taxes, $361 a month. Homeowners insurance, about $100. Mortgage insurance, about $175 a month. Now, the great thing about this spreadsheet is that it shows you different risk zones. So safe would have a front end debt to income ratio of 23%, a back end of 31, comfortable 28 and 36, front end, back end, confident 35% front end, 43% back end, stretch. I do see people all the time buy homes in this debt to income ratio range of 42 front end, 48 back end. It might just feel a little bit more tight, but they're going to have no issues qualifying. Risky is like max qualification usually. Probably don't recommend this. So if you can, I would say, stay within stretch to safe, but it breaks down the different purchase price, the down payment needed for it, and then the mortgage payment, the all-in mortgage payment. And so down here, you can actually pick, let's say you want to go with a confident number. The purchase price is around $500,000. Like we said in this example, this is the down payment of about $17,000. This is the closing cost, about $13,000. So you're looking at around on a $500,000 purchase price, 3.5% down on an FHA loan, about $30,000. The closing costs could vary depending on the situation. And then once we get through that portion, I do include this other costs, this other monthly cost section that takes into account estimated utilities and estimated savings every month for maintenance. So you can put in the estimated square footage. So let's say, like a 1,400 square foot home, 500K in the Inland Empire, pretty reasonable, I think. Utility cost per square foot. If the home is older, you might want to put high. If it's a newer, you might want to put low, because if you have energy efficient appliances, energy efficient windows, stuff like that, that could change the cost of utilities. And then obviously maintenance. So if it's a new build home built within the last 5 years, this is probably going to be a lower number. But if it's an old home and you think you're going to have to eventually replace the roof, you're going to have to replace your furnace or your air conditioning, I would put this number as high. Now, these are obviously maintenance savings is recommended. You don't have to do it, but it is recommended. And so this down here will break down that mortgage payment based on the risk level that you chose. And then it will also show you the other costs. So in this scenario, your total estimated monthly cost is going to be about $4,125. And this is going to be around 48% of your take home pay. And a big thing here to consider is that going to feel like a comfortable monthly payment for you? And speaking of comfortable monthly payment, I do share 2 rules suggested by financial advisors. I'll cover those 2 affordability rules. Obviously, I'm not a financial advisor. I just talk to a lot of them. And these are 2 rules that they suggest for a lot of people. There's going to be another tab at the end that's called an offer guide. And that will just show you different price points when you're submitting offers. You might want to go 5% lower or 5% higher. And that breaks it down for you. Earlier in the video, I mentioned debt to income and the debt to income ratio. That's how you're going to get qualified for a loan. If you want to know how all the math works, you can follow along down here. It'll break it all down for you and it'll show you how I got these numbers. But let's go back into affordability. So if you go into this tab, the first one is the 2836 rule. And it's just a classic lender approved guideline that's going to help you avoid feeling house poor. And what it means is you're not going to spend more than 28% of your gross monthly income on your total housing costs, right? That's going to be your mortgage, property taxes, insurance, HOA, all that stuff combined. And then you're going to want to keep all of your debts, car payments, student loan, housing, under 36% of your income. And so in that scenario, if you want to follow this rule, this would be the purchase price that you're looking at, $393, and your total payment would be around $3,000, which would be 35% of your net income. So that would keep you within the 2836 rule. The next one is a super conservative way, but if you can achieve this, congratulations, you're probably setting yourself up for long-term financial success. This is the 3033 rule. I think Dave Ramsey, preaches it. It's pretty popular, but essentially it says mortgage is less than 30% of your gross income. Have 30% of your home price saved before buying. 20% of that 30 will be for down payment. The other 10% will be for closing costs and an emergency fund. And last but not least, maximum purchase price is only 3% of your annual gross income. In this example, these two actually come out to be pretty close in terms of the purchase price. This one is $390. If you look at this down payment, it's about 6 times more. But if you look at your monthly payment, it's about $600 less a month. And so like I said, I'm not a financial advisor. All the numbers in this right now are for educational purposes. But if you do want to speak about your specific scenario related to home buying, my email is darren@realdarrensci.com. Now let's go into the offer guide tab. So in here, it will show you based off of what you picked over here. Let's say you pick comfortable. Your offer guide will show you this comfortable price, and then it'll show you 10% lower, 5% lower, 5% higher, 10% higher. Shows you the purchase price, estimated down payment, closing costs, the mortgage payment, and then it actually compares each of these compared to this one. And on top of that, if you want to just put in a specific price, so we want to do 500K, it will compare it to the comfortable risk zone, and it'll show you same thing, down payment, estimated closing costs, estimated cash to close, mortgage payment. And in this scenario, the comfortable risk zone is quite a bit different than the 500K example. If we go into that confident risk zone, it's pretty close. It's only $500 more at 500K to close, and your mortgage payment is an estimated $62 a month higher. Okay, so this was for the FHA example at 500K, 3.5% down. Now let's go into a different example for a conventional loan, 800K with 10% down. So as you can see, this thing's going to be pretty easy to update now that you know. Conventional loans typically have a higher interest rate than government backed. So we're going to say 7.5. We're going to keep the property tax the same. We're still looking in Southern California, so 1.1 is good. We'll say that this is a conventional loan with fair credit, so 700-ish. Just a real quick reminder on conventional loans. The minimum credit score is typically 620. Down payments can be as low as 3% for first-time homebuyers that qualify. Generally, I've seen people putting 5 to 15% down. And then for debt to income ratio, typically you can go up to 50%. But that's usually not recommended. And then let's go back into here. Same thing. We're doing a single family home, so there's no HOA. And let's say insurance tax rate is 20%. So in this scenario, most people that are looking at 800K homes in Southern California, their income is usually somewhere between 180 to 300, sometimes even higher. So for this example, I'll use 2 borrowers. One makes $120,000 a year. They have a $400 car payment. They have $100 in student loans. And the other person, let's say they make 90. Same thing. Their car payment, let's say, is 300, and they don't have any student loans. So now that we've filled this stuff in, we can go to the next tab. And so their comfortable zone is actually around a 600K purchase, but their total monthly payment is going to be around 5K a month, right? And that's going to be on about a $60,000 down payment with about 16K in closing costs. And so once again, we get this different range. In the confident range, they're looking around 760 for a purchase price, and their mortgage payment is around $6,125 a month. So I'm going to leave it at confident, and we're going to actually just compare it to the 800K purchase price. And I would actually say you could use 2% of closing costs here. So the estimated cash close is going to be about $90,000 in this scenario. Let's just take a quick peek at affordability. So if they follow these financial rules, they should be staying under a $650 purchase price. But let's go ahead and now compare the Confident to an $800K purchase. So estimated cash to close here is going to be $100,000, and the mortgage payment is going to be about $6,500 a month. As you can see, this tool that I made, it's going to help you walk through different scenarios pretty quickly once you understand how to use it. Now that we've gone through those examples, you might be curious about your scenario. And if you want to see what you can afford, whether it's a $300K home, $500K home, $800K home, $1.6 million home, you can download the spreadsheet for free, or if the spreadsheet seems a little overwhelming for you, you can book a call directly with me and we can go over the numbers together. As always, thank you so much for watching these videos. If you thought this video was helpful, I would really appreciate it if you could share it with someone else that you know it will help.